Hello, 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 hello. Welcome to another day with the SBDC, which is the best way to start your day, even though it's, 10 o'clock. Waiting to see other people getting in. We had about 28 people sign up for the webinar. So we want to make sure we give them some time. So as we are waiting, I want to respect your time, that the people that came on time. So let's start with just some introductions. This is the 2026 mandates. We do this at the end of every year where we look into the future as much as we can as what we know that might be changing with both federal and or state mandates that businesses should know about. With me is my counterpart, Dan Umphrey. We'll get to introductions in a second, but hopefully you're in the right webinar. Uh, what we're going to cover in this webinar, we're going to cover some new 1099 thresholds, minimum wage, family leave law, PTO and mandatory retirement, just briefly, the show-up pay or report to work law, Maine sales tax on digital products and subscriptions, sales tax on leases, tariffs. Yes, tariffs, just briefly. We're going to put a little watch on a bill that's making its way through the state that would affect residential builders, and then get to some more federal tax law changes that are coming up. This webinar is being recorded, so it will live on YouTube ever after. But if you have questions, especially if it's a general question, please feel free to put it in the chat. I am right now putting in a hello in the chat. So if you're new to the Zoom platform, you should see on the bottom probably like a blinking light where the chat is. So feel free to put questions in there as we go. We will have a time after the presentation to talk about your questions. So feel free to wait till then as well. If you don't, that's the whole reason that I put my name or my email address rather, where my name should be under my picture. So by all means, feel free to email me if it's a very specific question. So if you're a question that's just for you and it's pretty nitty gritty, then email me specifically. But otherwise, if it's a general question, more than likely someone else has that same question. So feel free to put it in the chat or wait till the end of the presentation. But these are just kind of what we're thinking about covering today, what we will cover today. So who am I and why am I talking about this stuff? So my name is Peter Harriman. I've been here for 10 years now. I cover basically southern Maine, but mostly Cumberland County. As I said, my email and contact information there. And I have with me my colleague, Dan Umphrey, who will be coming on and taking over later, who's been here for a while as well. He's up in the northern half. So we got the southern and northern half covered for Maine. So who exactly are we and what are we covering? Well, we are the Small Business Development Center, this SBDC for short. We provide no cost, confidential business advising, one-on-one, or webinars like this as well. And we cover the entire state of Maine. So within the state of Maine, if you need business advising and you want a one-on-one in-person meeting, you're going to be able to meet with one of our advisors within a reasonable drive time. Right. So how do we do this? Because Maine is a big state. We have partners, right? So I am partnered with USM. Dan is partnered with Northern Maine Development Commission, and we also are partnered with AVCOG, the Androscoggin Valley Council of Governments. So through those partnerships, and Maine is all about partnerships and collaborations, we can cover the entire state, right? So what it differentiates us from other similar type services? Well, again, no cost, though it is taxpayer funded. We really excel at that one-on-one advising where you can actually talk to a person versus, I don't know, ChatGPT. We have resources at our disposal where we can look up research for you, see what the industry standards are. We do these webinars to help businesses understand business. And we have professional development to make sure that we are on top of what the changes are in business and the newest trends. So we know our stuff. But we are not lawyers. We are not accountants. We're not to replace those. So during our talks or during our presentation, there might be times where we say, hey, you might want to talk to a lawyer or an accountant about this to make sure that it fits with what you're doing, right? Now, if you did want to sign up for advising, you can go to our website, and on our website in the top right corner is just this request advising button. Feel free to hit that request advising and we'll get in touch with you. Or if you're more interested in just content and or where this lives, we have a YouTube channel, and on our YouTube channel, you can hit the playlist and sort by different topics. Or you can subscribe, and then each time we do one of these webinars and put it on YouTube, you'll get notified of a new YouTube out there. Right now, on with the show. Right. So to begin with, forms. Right. We A lot of us, especially small businesses, have been concerned with the 1099-K form. This is a form that reports payments from payment apps like PayPal and Venmo and stuff like that. So we originally were going towards, this was the sort of original schedule. Starting in 2023, where there was a $20,000 threshold, we being the federal government, were working down to get to a $600 threshold come 2026. So starting next year, where it was going to be $600, you'd get a 1099-K to report your income. That would be sent to the IRS and to you, and you'd know, hey, I should make sure my records match. That is gone. It is now back for 1099-Ks. It's now back to the 20,200 transactions or more for both the federal and state thresholds. So ignore everything that has been happening in the last couple years. That is out the window. Now, regardless of whether you receive a 1099-K or not, all income should be reported as taxable income on your taxes. But the purpose of me saying this is you will not get necessarily a 1099-K if you are under this threshold of $20,000 and 200 transactions or more. If you're above it, you will get a 1099-K. Your records should definitely match what is being sent to the IRS. So make sure that it is correct. Right. Now, speaking of 1099s, there's also 1099 NEC or MISC. That's the 1099s that you would give a contractor. So the 1099s we're just talking about are ones that you would receive from payment apps because you are running your business through a payment app and you were transacting a certain amount of business. The 1099 NEC, which is non-employee compensation or miscellaneous, either one of those has also changed their threshold. For years, I think 40 years, it's been $600. That's where that $600 comes from that we were working towards previously. Well, in 2025, it is still $600. So for this closing tax year, if you had a contractor that made $600 or more throughout the year, you will still have to send them a 1099 NEC or miscellaneous, right? Depending on what industry you're in. Starting next year, 2026, that $600 threshold is getting bumped up to $2,000. And then in 2027, that will be adjusted for inflation and that'll be adjusted yearly. So rather than this artificial 600 kept for 40 years, they are bumping that up. So what that means for you, the small business owner, is for this year, 2025, if you had a contractor who made 600 or more, you're still going to have to do the 1099s. Send them out to the IRS and the contractor. Next year, it's $2,000, and then going thereafter, it's going to change. So that's a big change from what it used to be. So hopefully that was a mix of good news for you. Now, again, even if a contractor doesn't get a 1099, if you are making income, you are supposed to report that on your taxes. So not saying that if you don't get this, you don't have to report it. Just saying the thresholds of when you're mandated to report them is when it has changed. Yeah. Now, another change that we've seen coming, minimum wages, right? And remember, minimum wages are for non-exempt workers, because we'll talk about exempt workers in a second. So non-exempt workers are basically, they're not exempt from overtime. So they are workers that if they work more than 40 hours, they're going to get overtime, is basically how it goes. The federal minimum wage set in 2009 at $7.25 an hour is still there. However, Maine's minimum wage, and you do which one is higher, Maine's minimum wage is higher, right? So that is the minimum wage that you end up doing. So for the state minimum wage, we're going out of the 1465 for non-tipped workers and going to $15.10 for most of Maine. Now there are some exceptions. Portland is one of them. I have a whole slide for Portland, but Rockland is also an exception. So Rockland, for businesses who employ more than 25 employees in Rockland, their minimum wage in 2026 is going to be $16.02 for the non-tipped, right? The tipped are half of that. So if you're in Rockland employing more than 25 employees, you have a different minimum wage than the state minimum wage. For everyone else outside of Rockland and Portland, you're going to be going up to $15.10 for non-tipped, $7.55 for tipped. For Portland, as I said, they had a referendum that passed and was voted on and passed. So starting January 1st of 2026, the effective minimum wage will be $16.75, and then $17.75, and then $19 in 2028. And then beginning 2029, that will be subject to annual cost of living adjustments. But for the immediate term for 2026, it's going to $16.75, so it's a little above the state minimum wage if you're based in Portland. Now, the biggest change to minimum wage that didn't get much news at all was agricultural workers are no longer exempt from minimum wage. This reverses 90 years of being exempt from minimum wage, right? This was established in the 1930s. So this, previously, they had to abide by at least a federal minimum wage, but not the state minimum wage. So this is a big change for those in the agricultural business, okay? The law, if you want to look it up, it's LD 589. It passed in June of 2025. It's going to be effective 2026. The long story short is you're going to want to provide a little more documentation on how your workers are meeting minimum wage. Because up until now, especially with the federal minimum wage being so low, you didn't really worry too much about it. But now, if someone says, hey, I'm working a lot, but I'm not meeting minimum wage, you got to be able to show that, hey, yes, for the work they're doing, for the hours they're doing, they're making at least the $15.10, right? I think that's what it was. But Your Honor, I'm exempt, right? So exempt workers, these are workers usually in the professional field that are not, they're exempt from overtime. So some weeks they might work more hours, some weeks they might work less hours, right? So these are usually salaried employees. So they have a salary per year, and when they need to work more, they're expected to work more, and when they work less, they can. So that is also going to be going up. It goes up annually. 2025, the minimum, the base floor was 43,950. In 2026, it's going to be 45,300. So if you're salaried, you're exempt from overtime, you should not be making less than that, right? So if you're an employer hiring someone in a professional degree saying, hey, you're exempt from overtime, you're not a non-exempt, so you can't get overtime, then you want to make sure whoever you're paying that they meet at least that basic $45,332 for the year. Okay. A little side note, there has been talk of legislation that would increase that quite a bit. We're still watching for that. So keep your eyes out because that might change that. But we'll let you know. Now, Maine paid family leave. I'm going to spend a little more time on this because this is newish, and I think this is where a lot of people might have some questions. But starting January 1st of 2025, employers have been paying in to the Maine paid family leave. If it's under 15 employees, then you only had to do 0.5% rate, and it could come from either the employee or from the employer. And I think a lot of employers decided to just deduct it from the employee's wages, like another deduction. If you're 15 or more employees, you had to pay 1%. And no more than 0.5 could have been taken from the employee wages. You could decide to do it all, but I think most employers decided zero point 0.5 from the employee and zero point 0.5 from the employer. So you pay half, I pay half, and we get that 1% rate for 15 or more. Um, Self-employed individuals could and still can sign up for Maine paid family leave. So if you're self-employed, you can go to the portal and you can sign up for this as well. So it is a benefit you can get. Unlike unemployment, you can get this benefit. Okay, that's a big change. But why I'm talking about it is beginning on May 1st of 2026, people are going to be able to request Maine paid family leave. So it's good that we kind of start wrapping our heads around of what to expect when people do this, when employees do this, right? So what does it mean, right? So the portal, I checked to see if there was a portal where you can actually make a claim that haven't been established yet. So there is no portal yet, but there will be a portal that the state does where you send your employees if they want to put a claim in, right? The website here has a slew of information for both employees and employers. So I highly suggest that you look through that because they keep it very updated with the information that you need. It is a little overwhelming, which is understandable. Just kind of go through it. We can try to answer questions as well, but it is changing quite a bit. And so you can also elect to talk to a lawyer, talk to HR, make sure that if you do decide to act on something that it is appropriate, right? But overall, the reasons to take it, I'll get to in the next slide, right? But the time off can be up to 12 weeks per year. So 12 weeks starting from the time that they take it. So it's not something where every January 1st, suddenly they get 12 weeks and they can use it till December. It's if they take leave April of 2026, then they have 12 weeks till the next April of 2027, right? So they can take continuous leave, intermittent leave, or reduced schedule leave, right? Obviously, continuous leave is they just take a big chunk. Intermittent is they take maybe 5 days here and 5 days there, throughout the year. And reduced schedule obviously is, maybe they were full-time and they go down to a part-time schedule. Um, Once an employee files a claim on the portal, the employer will be notified within 5 business days. So if someone does go to the portal and does a claim, you're going to get notified as an employer that, hey, this employee just filed a claim for taking paid family leave. The employee needs to submit no more than 60 days prior and no more than 90 days after the start of that paid family leave. So it's a weird situation where if you have someone who's an employee who's very responsible, let's say uh, the new child's going to be in their life and that child's going to be born in 6 months, let's say, or adopted or whatever, then and they're trying to plan this out. Well, I believe the portal will only allow them to submit it up to 60 days in advance, but you can plan things out prior to that. But the 60 days, that's where that 60 days comes from, is the portal's going to say, okay, you can do it now. What are the covered reasons? Medical leave, right? If there's a serious health condition of yourself preventing you from work, parental leave, so time to bond with a child, and that's for mothers and fathers. Uh, whoever it is. That could include fostering and adoption as well. Family care leave, time to care for a loved one in a serious health condition. Military family leave, so time to prepare if a family member is being deployed. And safe leave, time to find safety after if you're a victim of abuse or violence, right? So there's quite a few reasons that they could take leave. Now, what to expect as an employer? The employee should give reasonable notice of intent to use, right? It can be the family member of an employee as well. That's a kind of important distinction. Why I give that distinction is sometimes reasonable is squishy, right? So if someone has a heart attack and goes into the hospital, they might not be able to give you reasonable notice because they're in the hospital, but their family member might be able to do that, right? So what this reasonable notice should include is the reason for the leave, the type of leave, is it going to be continuous, intermediate, reduced schedule? What do we think the timing and duration is going to be? So it's not going to be like, hey, I need a chunk of time. It's what is the exact kind of chunk that we need at this point? And any other relevant information that might be used to support what leave is being taken, right? This notice should be in writing. So I would highly suggest if you don't have a policy yet with your employees, you should probably create some policies, and create a policy where, hey, if you need leave, that's fine, but you need to put it in writing, and this is what it should include, right? Just so everyone's on the same page. Now, when an employee does submit and you get that notice saying, hey, someone just submitted for Maine paid family leave, that's going to trigger a 10-day undue hardship review, right, for the employer, right? That can be waived. So if it's something both you and the employee have agreed on and the leave is fine, then you don't have to worry about this, right? But otherwise, if you get the notice and you're like, hey, this is going to be an undue hardship to provide this leave. Remember, it's not a financial hardship necessarily because this is being paid just through your payroll deductions or whatever. But I have 4 points of when this would be a hardship for a business, right? So if the employer in a written explanation provides that, or demonstrates that the circumstances and the specific employee and the specific timing and the duration of the request will cause a significant impact on the operation of the business or cause significant expenses for the business, that could be an undue hardship, right? The employee retains the leave within a reasonable time frame relative to the proposed schedule. Uh, the employer has made a good faith attempt to work out a schedule for such leave that meets the employee's needs without unduly disrupting the employer's operation. So that would be like if you're trying your best to accommodate someone who wants not so much continuous, but maybe intermittent and reduced schedule, and it's just not working out, but you've really done a good job at documenting how you've tried to accommodate the leave to the best of your ability. And last but not least, if the person going on a medical leave needs a year of medical leave to recover, and they're thinking they're going to take 12 weeks and then leave because they need more time because they need a year. Well, if the leave is longer than the amount, then that might not fall under that might be an undue hardship for a business to say, I need to keep this job open even though he's not coming back, right? Which leads me to if an employee is returning from leave, right? Any employee that's employed with an employer for at least 120 consecutive calendar days, when they come back from leave, they're entitled to be restored to an equivalent position and equivalent employment benefits, pay, and other terms, right? So basically, the leave is saving their job, right, from the fear of leaving and then coming back and they don't have a job. Right. With the exception of if, again, kind of ties in that fourth one we talked about just a second ago, if the employee, especially if the employee notifies you that they're not planning on returning from their job, and I would get this in writing, I wouldn't say, oh, they told me this. If they're not planning to return after the FMLA is used or the Maine paid family leave is used, then you're not obligated to keep the job open. So again, in writing, right? And again, might be good to consult lawyers and or go on that website or ask specific questions of the Department of Labor on specific instances. I think more will develop out of this, and there'll be more clear guidance coming up and webinars coming up from the Department of Labor on Maine paid family leave. So keep your eyes out for that. I would imagine that would be coming out probably April-ish. But the SBDC will keep on top of it as well and provide our best knowledge as well. Now, there is still PTO and mandatory retirement as well to think about. So PTO is paid time off, applies to employers with more than 10 employees in Maine for more than 120 days. Basically, employees accrue 1 hour of earned paid leave for every 40 hours worked, up to 40 hours in a year, right? And the mandatory retirement which was, again, a relatively new one as well. That's an employer with 5 or more employees, part-time or full-time, throughout the year, needs to, at a minimum, send people to the Maine merit system and register on this merit system. It's a system where it has to be automatic for the employee. They have to opt out. The employee has to opt out if they do not want to participate. So it's not you, the employer, opting out. The employee gets a notice from the merit system when you register them, and they have to opt out for them not to participate in that. Now, mandatory retirement, PTO, and Maine paid family leave, all these mandates don't apply if your business already implements an equivalent or better system than what these are. So if you're offering 80 hours a year of paid time off to your employees, then you don't have to worry about the PTO. If you already offer a retirement program that's the equivalent, you don't have to worry about the mandatory retirement merit system. If you are already offering uh, paid family leave, that's 12 weeks throughout the year, you don't have to worry about it, right? Um, so these are for employers that don't have these systems set up. Now, there is also a new law that went into effect, the show up pay law, right? So if you're an employer with 10 or more employees and you're open 120 days a year, so this is not necessarily for seasonal employees who are open less than 120 days a year. So if you're 10 employees and open 120 days or more a year, if an employee shows up to work, but the shift was canceled, you would have to pay them the lesser of 2 hours of pay at the regular rate of pay or their full schedule shift. So if they were only scheduled for an hour for some reason, and that was less than 2 hours of pay, then you'd just pay them the lesser, right? Now, this does not apply if the employer can show that they made documented good faith efforts to notify the employee of the change of the canceled shift before arrival. So again, going back to, do you have a policy manual in place? And with that policy manual, maybe there's a policy of, hey, when are you notified of a canceled shift? Maybe we need to make sure we have your cell phone number and your email. And maybe we say, okay, prior to a canceled shift, we would send out an email and then send out a text or call or whatever, right? So have some kind of good faith effort documented of why you would do it. Now, for Maine, because I know there's a storm on its way, right? So there is another exemption. Adverse weather does not necessarily count as a canceled shift, as well as natural disasters, right? So if there's a snowstorm and that's the reason why the shift is canceled, that doesn't fall under this show up pay law. This is for shifts, it's not busy enough for them to come in. So you say, yeah, they show up and then you say, yeah, you might as well go home. It's not really that busy. Well, that's what this law is meant to alleviate, right? So the show up pay law. Tariffs. Yes, 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 yes. More about tariffs. I know we all hear about tariffs just about every day for the last year. So I have the good, the bad, and the ugly about the tariffs. Okay. And I'm going to start with the bad first because might as well get it out of the way. There's some belief that the courts will rule the tariffs unconstitutional, and that's not a political statement, it's just what it is. The government could still implement tariffs under different rules. So when you look at the reasons why tariffs are put in place, there's sometimes national security reasons, sometimes there's economic differences reasons. There's a whole bunch of reasons that the government can implement a tariff. So if one reason is unconstitutional, there could be another reason that falls under it. So tariffs might not be going away, right? That's kind of the bad. The ugly is if the tariffs are unconstitutional and the government had to refund them, it's probably going to result in multiple class action lawsuits where consumers who are forced to pay higher prices for tariffs could hypothetically try to get their money back, right? Don't think that's necessarily going to affect many of you all, but the good, sort of, is that the tariffs have done a job of breaking the consumer's confidence in free shipping on products ordered, especially products online, right? And this is driving more consumers to spend in stores versus what I call Amazon shopping. And that's when, and I'm sure if you're a retail store, you've seen this. People come in, they look it up on their phone, they see it's $5 cheaper on Amazon, so they order it. Well, the good sort of news is now that the cost of shipping is now included for a lot of these different products, that's driving more people to say, well, it was cheaper, but now it isn't. So use that to your advantage as a small business as much as you can. I know costs have gone up, and this is not a political statement. I don't want it to be, but there is a silver lining on the tariff issue. Hopefully I dodged that one, right? So now I'm going to turn it over to my colleague for the latter half of this presentation for sales tax on digital products.
Thank you, Peter. Good morning, everyone. I know Peter did a great job introducing me. I'll do so again real quickly. My name's Dan Umphrey. I work up at the Northern Maine Development Commission. I'm also an SBDC business advisor like Peter. I cover pretty much all of Aroostook County. So if you feel you are in need of business advising services and you're located up in the snowy north, chances are you'll be working with me. I am going to be talking about some miscellaneous changes to Maine tax law, as well as some federal tax changes. We're going to be kind of jumping through a lot of different kinds of subjects here, and our hope here is that we're going to tee up certain things that may be applicable to your business. We're sort of limited on time, so we can't do too deep of a dive into each one of these changes. So we really encourage you, if you think any of these changes may apply to your business, that you note that and explore how this may affect your business with your accountant or business advisor. So that's our hope here today, is that we're going to sort of prepare you for some changes that may come into effect in 2026. There are also some things that actually began in 2025, but with tax season coming up pretty quickly, we want to help prepare you and tee up some of these issues for you. So the first change that we're talking about today is sales tax on digital products. Starting in January 1 of 2026, Maine law LD 210 is expanding the definition of taxable digital services. This is basically streaming and subscription-based digital services, and the first ones you think of are the streaming platforms like Netflix, Disney, Amazon, also music and podcast subscriptions, Apple Music. There's a lot of different kinds out there, ebooks and audiobooks. A lot of us have Kindle downloads, audiobooks, things like that. Other types of digital subscription content. Not necessarily with ownership, language learning apps, meditation apps, news and education platforms. So this will be a pretty big change, and especially if you are involved in software as a service. At this point, it's a little bit nebulous whether or not this is going to be covered under the sales tax on digital products changes. So if this is an industry that you are in, you definitely want to stay tuned, keep yourself educated, talk to your accountant to make sure that you're doing things correctly, and keep yourself updated on any changes to the tax law. Go ahead, next slide. There's been a change on sales taxes on equipment leases. If you read through this change, when I read through it, to be honest, I wasn't sure whether or not this applied to residential leases. But fortunately, this new sales tax will only be applicable to equipment. We've got the statutory reference up there. Prior to the change, if you were a person who rented out equipment, you would pay the tax on it when you purchased the equipment, and that would be based on the purchase price of the piece of equipment that's being leased or rented. Effective January 1, 2025, leaseors are required to charge and collect sales taxes from the leasee on each individual lease or rental payment on all tangible personal property leased or rented on or after January 1, 2025. This also includes leases that may have been entered into prior to January 1, 2025. But if the term extends beyond that date, then this tax will apply. So be wary of that. Each time period for which a lease or rental payment is charged, that's sort of considered, the separate sale from which you want to, charge your sales taxes. And again, the definition tangible personal property does not include real estate. So I just want to make that point. Thank you. Go ahead, Pete. Another big change, Maine is actually one of 6 states, only 6 states that historically has not required residential contractors, general contractors, to be licensed. However, we have always required electricians and plumbers to be licensed. And I think in response to over 3,200 complaints that had been lodged with the Maine Attorney General's office that resulted in hundreds of thousands of dollars in alleged losses, the state of Maine has decided to make a change, and they've passed the Act to Protect Consumers by licensing residential building contractors. Again, currently, general contractors are typically only licensed at the county or city level, but that's going to change. It's going to change likely. It has not been enacted yet. It's been passed by both houses, but it's basically it's been what's been termed carried over, which I think just means it's sort of teed up for the next session. So this is something you're going to want to keep an eye on. It's likely to pass. Like I said, it's passed both houses. If it does end up getting passed, it's going to require all residential contractors engaged in projects over $15,000, which modern times, that's pretty much all projects, right? You can't do much for less than $15,000 these days. So all GCs that are going to be engaging in projects over that amount will have to be licensed. The license is going to require, certain educational requirements, obviously. And I think the idea is that most current GCs are already going to have that requirement satisfied. So hopefully it doesn't impose an undue burden on these contractors. It does include some pretty powerful enforcement mechanisms. The Attorney General will be empowered to issue fines, penalties, and even suspend licenses for those who violate the new license requirements. So again, keep an eye, on the Maine legislature, and this may or may not pass in the next year. So if you are a general contractor, this is definitely something you want to keep an eye on. Next slide. So there's just some other miscellaneous Maine tax law changes. Some or all of these may not apply to you. Again, if they do, make a note of it. There's a new exemption. If you make sales to a nonprofit organization, those you may be exempt from collecting sales taxes. There are some rules, obviously. Only 501c3 nonprofits, which are your charitable organizations, and only if the nonprofit is going to use the tangible personal property or taxable services that you might be providing, they would have to use it primarily for the purpose from which that nonprofit exists or was organized. The nonprofit must also have an exemption certificate obtained through the Maine Revenue Services. So if this does involve your business, there's going to be certain things you're going to have to do to make sure you're complying with the law. So again, if this does apply to you, make sure you read up on this law, talk to your accountant, and be prepared. And the service provider tax, there's been a pretty significant change to it, just in terms of what it applies to. Uh, and there's some talk about the service provider tax being eliminated completely. Um, Generally, services are not taxable unless they explicitly say they are taxable. And the list here are historically services that have been taxable, but they have been repealed. Private non-medical institution services, community support services for persons with mental health diagnoses, community support services for persons with intellectual disabilities or autism, home support services, and group residential services for persons with brain injuries. So if you're providing services in these areas, the good news is it looks like the service provider tax is repealed. Again, this went into effect January 1 of 2025. Again, work with your accountant if this applies to you, because this will be coming up fairly soon for you. Next slide. Okay. If you are a retail business, convenience stores come to mind when I saw this tax change. The state of Maine has sort of broadened the definition of tobacco products. All products that contain artificial nicotine or tobacco-derived nicotine that are intended for human consumption are likely to be consumed are now subject to the tobacco products tax, as well as the applicable rate, whether or not it's smokeless or traditional tobacco products. Basically, if you sell a product that is tobacco related or contains nicotine in it, it's likely now going to be under the definition of tobacco products. So you're going to want to collect sales taxes accordingly. So that's something you definitely want to be aware of. Next slide. Now, as we all know, back in July, Congress, we're talking about the federal Congress now, enacted what's called the One Big Beautiful Bill. Included in this bill, and this was as you know, a very large bill that touched upon many, many different subjects and industries. But there were certain tax changes, federal tax changes, that were contained in that bill. Now, typically, whenever the federal government makes, especially significant federal tax changes, the states will then, work towards either conforming or remaining non-conforming to those federal taxes. We're getting into some pretty, complex tax law types of subjects here. So again, if you feel any of these subjects are applicable to your business, this is definitely an area where you're going to want to have an accountant that helps you out. And you definitely want to go over some of these issues with him or her. Generally, any tax law changes would go into effect at the beginning of January 1, 2026. However, there are several retroactive changes that were made that are going to affect the tax years beginning in 2025. Again, these are federal changes. Some of those changes that went into effect in January of this year include extension of certain qualified disaster-related casualty losses, election to defer taxes on the gain from the sale or exchange of certain qualified farmland property, immediate expensing of certain business property under Code Section 179. So this one may actually apply to some of you. That includes certain research and experimental expenditures, the federal business interest deduction, and accelerated depreciation for qualified production property. Again, if you think any of these things may apply to you, you definitely want to look into these changes. Again, consult with your business advisor, consult with your accountant to explore the impact or non-impact of these changes. Next slide. Now, there's been some additional federal tax law changes, but we understand these changes are going to have no impact on Maine tax law. So you may have a situation where your federal tax return, there are some changes to it, but your Maine return may be different. It may turn out different. in terms of what you may have to pay in, what you're entitled to a refund. We may start to see some shifts where you're maybe even having to pay in more in your state refund than your federal refund. But these following tax law changes are federal only. That includes the senior tax exemption, the car loan interest deduction, deduction for certain tip income, and we're going to go over some of these in a little bit more detail. The deduction for certain overtime pay or no tax on overtime. These changes do not affect the federal adjusted gross income. They're below the line deductions. And unless Maine enacts conforming legislation, these changes will not impact your Maine return. So these could be situations where your returns are a little bit different, which again, just sort of reinforces our advice, especially when there's, these sorts of changes that are happening. Very good idea to have an accountant or a good tax preparer help you out to navigate through these and make sure you're not doing anything incorrectly on your returns. Next slide. Now, there's major items that that 2025 Maine tax forms and instructions will conform with. Again, we've already sort of gone over these in the first slide when we were talking about the federal changes. Again, the disaster losses, the qualified farm property, Code 179 expensing. Again, that allows businesses to immediately expense the full price of qualifying equipment or software placed in service during the tax year, rather than depreciating the costs over several years. The business interest deduction and certain research and experimental expenses. So these are federal changes that it appears that Maine tax law will conform to. Again, same advice. If you think these things may apply to your business, make sure you can educate yourself a little bit more on these changes. And if you do so, I'd suggest you stick to the IRS website or the Maine Revenue Services websites. They often provide good written instructions, good explanations, and they're written in a way that not just lawyers can understand. It's often written in layman's terms. That's fairly straightforward. I'm not going to say easy to understand, but they do make an effort to describe these changes in a way that is understandable to the common man or woman. And they often provide examples. So it sort of illuminates how a lot of these changes are going to work. Go ahead, next slide. Actually, before we take questions, I did want to expand a little bit more on the no tax on tips and the no tax on overtime, because that's something that's likely going to impact the majority of businesses. The no tax on tips. So this is effective for 2025 and through 2028. And you can deduct up to $25,000 in tip income. There are certain qualifications. So there's, I think the big, thing to remember there is whether or not the taxes or the tips are voluntary or whether or not they're put right on the bill. In order to qualify for the no tax on tips, it has to be voluntary. So this is something if your practices are that you add the tip directly onto the receipt or to the invoice to the client, you may need to change how you do things if you want your employees to be able to take advantage of the no tax on tips. And the no tax on overtime is similarly, it's effective for 2025 through 2028. And individuals who receive qualified overtime compensation may deduct the pay that exceeds their regular rate of pay. Usually overtime is, time and a half or even double time. So you can deduct the pay that exceeds your normal rate of pay. The maximum annual deduction is $12,500 for individuals and $25,000 for joint filers. The deduction's available whether or not you itemize or take a standard deduction when you're doing your taxes. And you'll just need to include your social security number on your return in order to claim the deduction. The no tax on car loan interest, there's certain qualifications there as well. In order to qualify the deduction, the interest must be paid on a loan that originated after December 31st, 2024, that was used to purchase a vehicle, and the original use of which starts with the taxpayer. Unfortunately, it appears that used vehicles do not qualify. It must be for personal use. So if you use a vehicle in your business, this does not apply to that. Sorry. It also must be paid on a loan that's secured by a lien on the vehicle itself. So we went through a lot of different changes. Again, unfortunately, we don't have the time to do a real deep dive on each one. I think we've got 5 to 8 minutes left here. I'm going to turn things back over to Peter, and we'll see if we have any questions. Again, as Pete mentioned, if you would like to contact us directly, I'm going to say the same thing Pete did. If you have a real specific question, feel free to email me. But don't hesitate to register for free business advising services, and then you can ask us as many questions as you want. You'll have us one-on-one. You can't beat it. So, and I know Pete mentioned it's at no cost to you. How can you beat that, right? Okay. So I want to thank you all for your attention, and I'll turn things back over to Pete.
Thanks, Sam. Yeah, no questions in the chat that I can see, but like Dan said, questions are welcome. If we can't answer the question, I like to pride ourselves that we can get you resources and or other links to go down the rabbit hole, right? We're not going to leave you just hanging, just say, oh, nope, sorry. Now, as I said, we're not accountants and lawyers, and as Dan kind of pre-qualified as well. So there are definitely questions that you can ask that we can say, well, in our experience, this is kind of how it might go, but you want to check with your lawyer or your accountant, right? Especially as we get into Maine paid family leave, you could start getting into some sticky legal situations with possible employees, especially if there's abuse there, or with a lot of the tax law changes that Dan went through. There could be situations where it's hard to understand how it affects it federally, but it doesn't affect it from the state perspective or vice versa, right? So no one said it was going to be easy, right? And business certainly isn't getting less complicated. But as we do every year, we're going to try to do this mandate webinar where we kind of bring up the stuff that is new that you need to watch out for. There's past ones you can look up. We put it on YouTube so you can watch it whenever you want. Some of you might be watching it now on YouTube, right? But yeah, the crowd today has no questions.
I will say one other thing too. If you're even if you have a business and you just listen to all the different changes and things that Peter and I went over. If you didn't see anything that you think applies to your business, it's still a good idea to even if you go to Google and type in your sort of industry and type IRS changes or MRS changes. It's a good idea to constantly check those two websites and just to make sure that there haven't been any changes to your industry, because I'm sure there are things that we just didn't cover here today that may be applicable to your business. So again, right. I stick to the IRS and the Maine Revenue Services websites. They've got the best information, and it's written in a way that's understandable.
Yeah, because there's only so much you can cram in, right? Like one thing we didn't cover was I think the liquor license now is all online. You don't do paper forms